I would like to see additional reforms to the Libor process, assuming that Libor will continue to be a benchmark for financial contracts.
The big lesson from this period was that there was nothing that anyone could easily have done to produce a benchmark interest rate in a situation when no one wanted to lend to each other. So what did you do? As I said, at the time, my instinct was to move to a situation based on a transactional rate, observed transactions. But of course, if there aren't any transactions, you can't really use that. And there's a massive transitional problem about what happens to the legal status of contracts, the $500 trillion contracts already out there, which have been based upon existing Libor. I have no simple answer to those at all.
Alternatively, there are a number of people looking at alternative benchmarks.
What we need to do is to get people in those markets to recognize that there cannot always be a reference benchmark rate under all situations of market stress.
The actions of traders and banks that have been disclosed are not only very troubling in themselves, but they have the effect of undermining public confidence in financial markets. And it's clear that beyond these disclosures, that the Libor system is structurally flawed, and part of the response was to address those flaws. The Federal Reserve Bank of New York, after receiving this information from its market inquiries, responded very quickly. And the New York Fed also communicated with the FSA and the Bank of England in the United Kingdom. So there was active effort to report to all the relevant policymakers and enforcement agencies the information that had been received.
But at no stage did he or anyone in the New York Fed raise any concerns with the bank that they had actually seen or had evidence of wrongdoing.
Today, do we know definitively that no U.S. banks were guilty of the same manipulation?
No, we don't know that.